Good evening. Thanks for joining us on Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. The Reserve Bank keeps the repo rate unchanged as expected, maintains the neutral stance. Governor Sanjay Malhotra reiterates the Goldilocks scenario for the Indian economy. RBI hikes its forecast for growth and inflation, expects GDP growth for this fiscal at 7.4%, projects inflation to cross 4% by October this year. Sovereign bonds decline as RBI refrains from fresh debt purchases. The rupee weakens by 30 paise against the dollar. RBI plans a framework to compensate customers impacted by digital fraud for up to 25,000 rupees, also doubles the limit of collateral-free loans to small businesses to 20 lakh rupees, allows banks to extend finance to real estate investment trusts. Sensex and the Nifty end higher for the second straight week. Mid-caps outperform, but IT stocks get battered. The Nifty IT index is down 7% this week. The tech rout on Wall Street keeps the markets jittery worldwide. Amazon pledges $200 billion, taking the total proposed spending on AI to a whopping $660 billion, including Google, Meta and Microsoft. Gold and silver prices remain under pressure. Bitcoin attempts to recover from a 16-month low. The proposed trade deal between India and the US will not include rice, wheat, soya, corn, sugar and dairy, according to government sources. Commerce Minister Piyush Goyal expects a joint statement and tariff reduction to 18% by next week. Civil Aviation Ministry informs the Parliament about repetitive defects in 50% of the 754 aircraft analysed across airlines in the last 13 months. 82% of Air India's aircraft, 37% of Indigo's aircraft analysed were flagged for recurring defects. However, the government does not specify whether these repetitive defects are critical safety-related faults or non-critical maintenance issues. UPL, Dhanuka Agritech, Coromandel and Crystal Crop Protection likely to be interested in buying the India assets of US-based agrochemical company FMC. Sources say the deal value could be around $450 million after write-downs. That's an exclusive. US companies slashed more than 1 lakh jobs in January. The layoffs are the highest for a month in 17 years since the financial crisis. Transportation, tech and healthcare account for a majority of the job losses. After weeks of tension and posturing, the US and Iran hold first stage of negotiations to prevent a war in Oman's capital, Muscat. Iran calls for a fair and mutually satisfactory agreement on nuclear power. At least 18 people are dead after an explosion at a coal mine in Meghalaya. Authorities say the rat hole was being operated illegally in what is one of the biggest mishaps in the last 12 years. Well, let's go straight to the top story this evening. The Reserve Bank's monetary policy. The repo rate was left unchanged as expected at 5.25%. In fact, all 6 MPC members voted to pause the rates. Now, the RBI has also retained its policy stance. It stays at neutral, with only one MPC member, that's Ram Singh, calling for a change to accommodative. On inflation, the central bank has raised its estimate by 10 basis points to 2.1%. That's for the current fiscal. Projections for the next 3 quarters have also been revised higher, with inflation expected to cross the 4% mark by October. The RBI has upgraded its growth outlook, projecting GDP expansion of 7.4% for FY26. That's up from the earlier estimate of 7.2%. Governor Malhotra said India continues to be in a Goldilocks scenario where growth remains strong and inflation stays under control. Take a look.
We are certainly, in the same sweet spot, maybe even better, because growth is looking up. Growth is looking even better, and inflation is the same. Headline, one is looking at headline, 0.1, 0.2%, 20 basis points here and there is a very small number. Point number one. Point number two, it is headline. As mentioned in my statement, it is primarily to do with base effects. It is primarily to do with the volatility in the food prices, core inflation, underlying inflation, barring precious metals, is very benign.
Well, that is the RBI governor on the Monetary Policy Committee's decision. Sovereign bonds declined after the RBI refrained from fresh debt purchases. 10-year yields rose to 6.75%, but the rupee weakened by over 30 paise against the dollar. That's where the rupee finally closed, 96.5, and that's the bond market action for you. The rupee has strengthened by nearly 1.5% this week against the dollar, boosted by the India-US trade deal agreement. The governor said the central bank is concerned about any undue and excessive volatility in the rupee, but he also added that the RBI is not targeting any specific levels. Let's go across to Lata now. She joins us to take us through what she made of the commentary that came in from the RBI. Lata, no major surprises from the RBI itself in the policy, but what do you make of the commentary?
Oh, yes, it was most status quo of policies. As you say, neither the rates nor the stance has changed, but that was as expected. The point is the governors seem to even hint that there is a long pause. That is, the repo rate may remain at 5.25% for a long time, because he said the positive real rate is in accommodative to neutral territory. What it means is repo rate minus inflation. Should repo rate at 5.25%, inflation rate, the forecast is around 4.5%. So the difference or the positive real rate is around 1 to 1.5%, which is the neutral rate. All this explanation was giving the impression that he's not going to change those rates anytime soon. All that was like on expected lines. But what was surprising was at the moment, there is a lot of liquidity in the system. So the call rate is often a good 0.5% below the repo rate, the one-day money. The Reserve Bank governor did not really address it, saying that broadly, it encourages transmission. That made mutual funds very unhappy because they are the people who put the money in what is called the TREPS market. And there they are getting only 4.25%, where they were expecting 5.25%. So they are unhappy, the banks are happy about it. But the point is the governor did not give a reason why he is not doing the, variable reverse repo rate, VRRR as they call it, to pull out the excess money. So mutual funds are unhappy. The other place where he did not commit at all was on the dollar rupee. The usual statement that, RBI only intervenes for volatility, they don't have a level. He also said that in the long run, the budget has steps, insurance, 100% FDI has been allowed, GCCs have been given safe harbor. These are all known, but on a daily basis, FPIs are pulling out money and pressuring the exchange rate. There was no real help for the market to understand that part better. So that's why I call it status quo and how in terms of this policy. But to be fair, on the governor's side, he did say that, the borrowing program will be managed by proactive and preemptive provision of liquidity. He also probably is not committing either ways because there is a new GDP and CPI series coming. So therefore, probably was less committing or less revealing as to what the RBI's thoughts are. This policy is status quoist and how. That's the only way I can describe it.
All right, status quo policy. Lata, many thanks. The RBI, by the way, also announced a slew of measures aimed at protecting consumers, and we'll get you that in just a bit. But let's talk about today's market action. The Lal Street closing in the green after a volatile session, the Nifty ending above the 25,650 mark. The mid-cap index underperforming. FMCG stocks ended at the day's high, and IT stocks extended their losses, closing lower for the third session. So that's the Nifty. Flat but in positive territory. The mid-cap index closing just about in the red, and the bank Nifty also closing in positive territory today. For the week, the markets have ended higher. That's for the second straight week, with the benchmark indices ending 1.5% higher. Mid-cap index has outperformed and ended about 2% higher. That's the picture for the week. The Realty Index up almost 5%, and the Sensex and the Nifty closing by about 1.5% each. Now, the tech rout on Wall Street is keeping markets jittery worldwide. Amazon has pledged $200 billion, taking the total proposed spending to a whopping $660 billion, including Google, Meta and Microsoft. We're talking about AI spending. Rima is standing by to take us through the massive capex plans that these tech companies have put in place and why that's making the markets worldwide nervous. Rima.
First, let's get the numbers. From the start of this year, Microsoft is down nearly about 18%. Software companies, Palantir, ServiceNow, Salesforce, all down close to about 30%. And most of the slide happened this week. Now, what drove the correction? One, the fear of AI. Not what AI is doing today, but what it can do tomorrow. So Anthropic Claude's plugins show that AI can now do sales, finance, legal, analytics. without the traditional software layer. So investors are now questioning the business model, the operating model of software companies. And secondly, the capex numbers. Now, Amazon's $200 billion capex spend guidance for 2026 spooked the market. And to put it in context, just these 4 big tech IT companies are going to spend $650 billion potentially in terms of an AI capex this year. Is this money going to generate ROI? Or are big tech companies perhaps stuck in a game where they need to spend just to survive? For Indian IT service companies, the impact is second order, but it's real. For one, the fear is of greater revenue deflation. 2, client decision-making gets delayed. What happens to the expected FY26 earnings recovery? Does that slip further? And will IT companies, especially the large IT companies, get stuck in this mid-single-digit kind of a revenue growth rate trap? But here is an interesting counterpoint. Cognizant CEO exclusively spoke to CNBC-TV18, and he said AI won't magically plug into enterprises and create value overnight. That has never happened with any technology. AI is a contextual technology. Value only comes when it's grounded in enterprise workflows, processes, and operating layers. And there is a need for IT services companies to act as a bridge between models and enterprises. Brokerages, though, remain a divided house. Now, Kotak says it's plenty of panic over a little flutter. So they're arguing that the reaction was actually disproportionate. The risk stems from the future unknown breakthroughs rather than proven impact today. But Jefferies, on the other hand, is a bit cautious. They believe that currently there will be some more growth pressures. Valuations could correct. There are downside risks to valuation, which is why they have a selective stance. But the pressure that we saw in the Indian IT companies came in from overseas. Nasdaq sold off about 6% in a span of 3 days. But just to put it in perspective, over the last 3 years, this is the kind of rally that we've seen in mega tech companies. Nvidia up nearly 1,500%. You had a 3,000 plus rally on Palantir, 800% on Meta and Broadcom. So just to put the kind of correction that we've had in context with the kind of rally that we've already seen in the last 3 years.
Well, it's important to put that in perspective. Rima, many thanks for joining us. And let's shift focus now to the India-US trade deal. Government sources say the proposed deal will not include rice, wheat, soya, corn, sugar and dairy. Commerce Minister Piyush Goyal said that he expects a joint statement and tariff reduction to 18% by next week. Abhimanyu standing by. Abhimanyu, the government trying to allay concerns on agriculture. What are your sources telling you?
Government sources have indicated that the India-US trade deal will not have any adverse impact on Indian farmers since several commodities have been excluded from the ambit of the deal, which include wheat, rice, soya, corn, sugar and dairy. Also, government sources had indicated that India has committed to buying items from the US which are already imported from other nations, and India imports products like oil, gas, aircraft, laptops, smartphones and goods for data centers. India currently imports around $300 billion worth of products annually, which will now be sourced from the US as well. India expects to hit $500 billion worth of imports from the US in the next 5 years. It remains to be seen how early this growth is going to be achieved. Also, the Commerce Ministry has indicated that the first tranche of the BTA between both the sides is already ready, and they are hoping to sign a joint statement in the next few days. Also, a formal agreement is being drafted, which will be signed by the mid of March possibly. It has been indicated by the Commerce Ministry that tariff reduction from the American side would take place, would be undertaken via an executive order once the joint statement is signed, whereas India's MFN tariffs, which currently apply to several American products which are imported into India, they would be reduced only when the legal agreement is signed. It remains to be seen how early all these processes are going to take place and how early the deal is going to take shape.
Abhimanyu, many thanks for joining us. Now, India's crude oil imports from Russia in the month of December fell by 33% compared to November. This as per the latest data. Now, Russia now accounts for less than 25% of India's overall oil imports in December. That's down from 34% the previous month. So as we've been pointing out, we have seen a consistent decline month on month of India's oil imports from Russia, and this number is likely to go down even further. Remember, President Trump has said that India is committed to buying zero oil from Russia and enhancing its import from the US. Now, we don't, of course, know the details of that, and the Indian government has chosen not to respond to that specific comment. Now, the race to acquire American agrochemical company FMC's India assets is heating up. Rachna joins us now with more. Who are the suitors, Rachna?
Well, sources have told CNBC-TV18 that the race to acquire FMC Corporation's India commercial business is gathering pace, with multiple Indian strategic players evaluating this asset. Now, people familiar with the matter say that UPL, Dhanuka Agritech, Coromandel International and Crystal Crop Protection are likely to be interested in the India business of this American company, but with more strategic players expected to join the process as it moves forward. Sources also indicate that the deal value could be around $450 million. This is after the write-downs FMC took as a part of preparing the asset for sale. However, the final valuation, bid structure and transaction format are still being worked out. FMC's India business, which is on the block, includes branded crop protection products, a pan-India distribution network and a long-standing relationship with distributors and farmers, making it a strategically attractive bet for domestic agrochemicals companies looking to scale up quickly. Now, FMC has already classified the India unit as held for sale in its FY25 accounts, formally signaling its intent to exit the commercial operations in the country. But the company has said that the India sale is a part of its 2026 operational priorities aimed at strengthening the balance sheet. FMC is targeting a $1 billion reduction in their debt through a combination of asset sales and licensing agreements while sharpening focus on its core global portfolio. So while the intent to sale is clear, the timeline has also now being straightened out, which would be 2026. We did reach out to all the companies mentioned, but are yet to receive a response from them.
All right, Rachna, many thanks for joining us. Now on to aviation. Civil Aviation Ministry has informed Parliament about repetitive defects in 50% of the 754 aircraft analysed across airlines in the last 13 months. However, the government does not specify whether these repetitive defects are critical safety-related faults or non-critical maintenance issues. Madhiya standing by with more. Madhiya, take us through what the Civil Aviation Ministry is telling Parliament.
Well, fresh government data reviewed since January 2025 now showing that 754 aircraft across Indian airlines were analysed for technical issues. And what clearly stands out is that 377 aircraft, which is nearly 50%, were found to having repetitive defects, meaning the same issues were being reported more than once. Now, if we look at the airline-wise numbers, Indigo analysed 405 aircraft, of which nearly 36%, which is 148 aircraft, had repetitive defects. Air India is particularly notable here. 137 out of the 166 aircraft showed repetitive defects. That is over 82% of the aircraft that were analysed. Now, Air India Express had 54 aircraft with repetitive defects out of 101 that were analysed, and SpiceJet reported 16 such aircraft, while Akasa Air had 14. Now, the key issue here is lack of clarity. The government has not specified whether these repetitive defects are critical safety-related faults or non-critical maintenance issues. That distinction is crucial here. Critical defects are those that can directly impact flight safety. These include engine failures, landing gear jamming, flight control or hydraulic failures, faulty sensors, autopilot malfunction or software issues. Experts warn that these kind of defects require immediate attention or grounding of aircraft because they can pose serious safety risks. On the other hand, non-critical defects are typically allowed under the minimum equipment list, or MEL as it is known. These often relate to cabin or passenger comfort issues such as inoperative in-flight entertainment screens, broken seats or tray tables that we see very often on social media. There's damaged interior panels or minor cosmetic damage. While the numbers might look alarming, the fact that these aircraft are not grounded yet and are flying indicates that these defects, even though repetitive, could not be alarming.
Well, we certainly hope so, Madhiya, and we would wait for the government to clarify. But many thanks for joining us. Back to the Reserve Bank's policy. The central bank announced a slew of measures to protect consumers, including a 25,000 rupee relief for those that have been hit by digital frauds. Ritu standing by with the details. Ritu, what is the central bank saying?
A whole bunch of measures aimed at consumer protection, starting with a draft guideline that RBI will issue on mis-selling of financial products and services by any bank or NBFC. Number two, when it comes to recovery agents and their treatment of consumers, where we've heard all kinds of stories, there again, RBI is going to review the rules and harmonize them across various categories of lenders. Number three, it is also going to issue a framework to limit the customer liability when it comes to fraudulent transactions. So for small value fraud transactions, RBI proposes proposes that customers can be compensated for up to 25,000 rupees. It will also issue a discussion paper to introduce safeguards when it comes to digital transactions. So, for instance, it could introduce lagged credits and additional factors of authentication when it comes to transactions by senior citizens. Now, apart from these, there were other non-policy measures as well. For instance, RBI is now proposing to permit banks to extend finance to REITs. It is also going to enhance the limit of collateral-free loans banks can give to MSMEs from 10 lakh limit currently to 20 lakh rupees. There will also be exemption for certain NBFCs that are not consumer-facing and that have assets of less than 1,000 crore rupees. They will not be required to register with RBI. And lastly, for certain categories of NBFCs that are lending against gold collaterals, they will now no longer require RBI permission to open more than 1,000 branches.
All right. Many thanks, Ritu, for joining us. U.S. companies have cut more than 1 lakh jobs in the month of January. The layoffs are the highest for a month that we've seen in 17 years since the financial crisis. Shilpa standing by with the details. Shilpa, the highest layoffs across sectors. Take us through who's been hit the hardest.
Well, January has begun on a rather weak note for the US labour market. Now, the 1 lakh job cuts in January is also more than double of last year's levels and more than 3 times the job cuts we saw in December. Now, the transportation and technology sectors cut the most number of jobs. Now, transportation tops the list because UPS alone laid off 30,000 workers after severing ties with Amazon. And that brings us to the second biggest sector handing out pink slips, technology. 22,000 jobs cut as companies continue to roll back pandemic-era hiring and flatten management structures, and that was led by Amazon's 16,000 layoffs. Now, healthcare is another pressure point. The sector saw over 17,000 jobs being cut, its highest monthly tally since 2020, and this as hospitals grapple with rising labour costs and tighter reimbursement budgets. Now, coming to the reasons cited, now contract losses and economic conditions were the biggest triggers, and they together accounted for more than half of all the layoffs. Now, restructuring and closures also featured prominently. But artificial intelligence, which has been the talking point, that was directly cited in just about 7% of all the job cuts, suggesting that while AI still remains a large part of the conversation, companies are still attributing layoffs to cost pressures and business realignment rather than outright automation. What also stands out is hiring, or should I say the lack of it. Well, hiring plans fell to just over 5,300 in January, and that's the lowest January number on record. Now, Challenger Gray and Christmas says that job cuts do tend to rise in the first quarter, but the scale that it's seen in January this year suggests that many of these plans were finalized towards the end of 2025, reflecting a more cautious view on the outlook for 2026 for the world's largest economy. Back to you.
All right, Shilpa, many thanks for joining us. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a minute with more.